Hey everyone, and welcome. If you're gearing up for your CI Inter exams, you're in the right place. We're about to do a super fast revision of one of the most critical sections you'll face, Section 139, all about the appointment of auditors. So let's just jump right in.
Okay, let's start with a quick question. True or false? Now think about this one carefully, because this is a classic ICAI trap. The tiny difference in wording here is exactly where so many students lose easy marks. We're going to find out the answer in just a bit.
To really get this stuff to stick, let's frame this whole session around solving a typical exam problem. Imagine this. A new company just wrapped up its first AGM. Now what? They've got to appoint their subsequent auditor. So, what are the exact steps they need to take to get it right?
All right, our journey starts with the foundation itself. Section 139, subsection 1. This is the rule that governs basically every auditor appointment after the very first one.
So, first things first, what even is a subsequent auditor? Well, it's pretty simple. It's any individual auditor or an audit firm that gets appointed by the members at the company's very first AGM. And just a small but important note, whenever the law says firm, you should always remember that includes LLPs, or limited liability partnerships.
Okay, time to solve that puzzle I threw at you in the beginning. So, an auditor's term officially starts from the conclusion of the first AGM and runs all the way until the conclusion of the sixth AGM. See the key word there? Conclusion. Their job isn't over the second the sixth AGM starts. It ends when that meeting is completely finished. So the answer to that question is false. It's a tiny detail, I know, but in your exam, that's the difference between getting full marks and getting 0.
So we know when they're appointed and for how long. But how is an auditor actually picked? What's the process? For that, we need to look at Rule 3 of the company's Audit and Auditors rules. It lays out the whole procedure for us.
The whole procedure really boils down to one simple question. Does the company legally need an audit committee? If the answer is yes, then the audit committee is the one that does all the initial legwork. They're responsible for checking out the potential auditor's qualifications, their experience, and digging into any pending professional cases against them. But if the company doesn't need an audit committee, then that same job falls to the board of directors.
Okay, now for a juicy scenario that the examiners just love to test. What happens if the audit committee says, we recommend auditor A, but the board of directors turns around and says, nope, we don't agree. This is a classic procedural twist you need to know.
So here's how that whole drama plays out. The board can't just veto the committee's choice. First, they have to send the recommendation back to the committee, and they have to explain why they disagree. Now, if the audit committee thinks about it and says, no, we're sticking with our original choice, then the board has to make a move. They'll formally record their disagreement and then put forward their own pick to the members at the AGM. Because at the end of the day, it's the members who make the final call.
Right, this is super important, so listen up. You absolutely have to know when a company is required to have an audit committee. These numbers are pure gold for case studies, so you gotta memorize them. An audit committee is mandatory for every single listed public company. For other public companies, it kicks in if they cross any of these thresholds. 10 crores or more in paid-up capital, 100 crores or more in turnover, or 50 crores or more in total borrowings. Got it?
Okay, so let's say a potential auditor has been identified. You can't just give them a handshake and call it a day. Nope. There's a whole paper trail of formalities that you have to follow, and it's all laid out for us in Rule 4.
So, before the appointment is official, the company needs to get 2 crucial things from the auditor they want to hire. First, their written consent, saying, yes, I agree to be your auditor. And second, and this is a big one, a certificate. Think of this certificate as a formal declaration. It needs to confirm 4 key things. 1, that they're eligible and not disqualified. 2, that the appointment follows the term limits. 3, that it's within the overall limits allowed. And 4, that they've given a true list of any professional proceedings against them. It's a really important compliance check.
Let's move on to what is easily one of the most tested areas in this whole chapter. I'm talking about mandatory auditor rotation, which is all covered in Section 139, subsection 2. Now, these rotation rules don't apply to every single company out there, so you have to know exactly who they do apply to. First up, all listed companies, no exceptions. Then you have unlisted public companies with a paid-up capital of 10 crores or more. For private companies, the bar is set a bit higher. They need a paid-up capital of 50 crores or more. And finally, this rule also applies to any company that has public borrowings or deposits of 50 crores or more. Again, these numbers are absolutely critical for your exams.
And here's the core of the rotation rule, laid out nice and simple.
For an individual auditor, the maximum continuous time they can serve is one term of 5 straight years. That's it. But for an audit firm, they get a longer run. They can serve for 2 back-to-back terms of 5 years each, which adds up to 10 years in total. This difference is a classic MCQ question, so make sure you've got it down.
So what happens when an auditor or a firm finishes their maximum term? Well, they have to take a mandatory break. It's called a cooling off period. The whole point is to keep the auditor independent and fresh. For a full 5 years after their term ends, that individual auditor or that audit firm is not allowed to be reappointed as the auditor for that same company.
And here is a sneaky little trap that ICAI just loves. The law is smart. It prevents firms from getting around the rotation rules. Here's how. A new audit firm can't be appointed if it has a partner in common with the old audit firm that just finished its term. This stops firms from just shuffling the work between 2 related entities. So definitely watch out for this detail in case studies.
We've talked a lot about the audit committee and the board, but let's not forget the final piece of the puzzle. Let's talk about the ultimate power that rests with the members, as laid out in Section 139, subsection 3.
Now, this is a really interesting point. Even if a company is too small to fall under the mandatory rotation rules we just discussed, its members, the shareholders, can still decide they want rotation anyway. They have the power to pass a resolution in a general meeting to force the rotation of either the specific partner working on their audit or even the entire audit firm. It's a great reminder of who is actually in charge.
So, after looking at all the recommendations, the disagreements, and all the rules, who really holds the ultimate power when it comes to appointing an auditor? Is it the experts on the audit committee, the powerful board of directors, or the collective voice of the members in the AGM? The answer, of course, is the members. They have the final vote.
Picture this. A company isn't happy with its auditor, and they want them gone, right now, before their term is up. So can they just call a general meeting, get a special resolution passed, and show the auditor the door? What do you think?
If you thought, yeah, a special resolution sounds powerful enough, well, you're not alone. You've just walked right into a classic ICAI exam trap. This is one of those topics that seems simple on the surface, but the procedure is full of twists, and that's exactly where so many students end up losing marks they really can't afford to.
So the real answer is a huge no. It's way more complicated than just one meeting. That's why in this explainer, we're going to get a solid grip on the entire life cycle of an auditor's role according to the Companies Act. We'll cover appointment, removal, and resignation so you can nail these questions every single time.
All right, let's start with the most common situation, what I call the normal path, reappointment. This is all covered under Section 139, and it's basically what happens at most annual general meetings when things are going smoothly.
So according to Section 139, subsection 9, the auditor who's finishing their term just gets reappointed. Unless, of course, a few things get in the way. First off, they have to still be qualified for the job. Makes sense, right? Second, they haven't sent a letter saying thanks but no thanks, I don't want to continue. And finally, the shareholders haven't passed a special resolution to either bring in someone new or to specifically say, we are not reappointing the current auditor. If none of that happens, they're back in.
Now here's a fun little twist. What happens if the AGM just ends and nobody was appointed? Does the company just operate without an auditor? No way. The law has a safety net in Section 139, subsection 10. It's what we call a deeming provision. The law basically says, hey, if you forgot to appoint someone, the old auditor just keeps the job. It's automatic. They continue by default. Okay, pen and paper time. This is a huge exam tip. This is where ICAI loves to catch students out. That automatic continuation we just talked about, it only works if those conditions from subsection 9 are still good. The auditor can't be disqualified, they can't have said no, and there can't be a special resolution against them. You always have to link subsection 10 back to subsection 9 in your mind. Don't forget that.
And one last thing on appointments before we move on. We can't forget the gatekeeper. If the company is big enough to need an audit committee under Section 177, then any auditor appointment or reappointment must consider what that committee recommends. It's a non-negotiable part of the process.
Okay, we've handled the smooth sailing, now for the drama. This is the scenario from our opening question, the forced exit. This is the tricky procedure for removing an auditor before their time is up, and it's all laid out in Section 140, subsection 1.
So here it is, the correct procedure, and every step is a potential mark. First, the board of directors has to pass a resolution. Then, the company has to apply to the central government using a form called ADT2. And here's the kicker,
Only after they get the green light from the central government can they then call a general meeting to pass that special resolution. And through it all, step 5 is crucial. The auditor has the right to be heard.
All right, highlight this in your notes because ICAI absolutely loves testing timelines. From the day the board passes its resolution, the company has just 30 days to get that ADT2 application to the central government. Then, once the government's approval comes through, the clock starts again. The company has 60 days to hold the general meeting and pass the special resolution. 30 days and 60 days. Burn those numbers into your brain.
Now, that whole right to be heard thing, it's not just a polite suggestion. It's based on a fundamental principle of law called audi alteram partem, a fancy Latin way of saying, hear the other side. It's a core principle of natural justice. The law insists that the auditor must be given a fair shot to state their case before they can be removed.
Okay, so what if the auditor is the one saying, I'm out? Let's look at a voluntary exit, or resignation. This is covered in Section 140, subsections 2 and 3. And guess what? The auditor can't just pack their bags and disappear. They have some important duties to fulfill on their way out.
The number one duty here is to file Form ADT3. They have 30 days from the date of their resignation to do this. And it's not just a blank form. They have to clearly state the reasons and facts behind their decision to leave. This form goes to two places, the company itself and the Registrar of Companies. And listen up, because this is a classic MCQ point. If it's a government company, they have to send a copy to the big boss of government audits, the CAG, as well.
And what happens if they don't file the ADT3? Oh yeah, there are penalties. The starting fine is either 50,000 rupees or the auditor's fee, whichever is less. Don't get caught out by that whichever is less clause. It's a favorite for trick questions. If they still don't file it, they get hit with an extra 500 rupees for every single day of delay, although the total penalty can't go over 2 lakh rupees.
All right, let's look at another tricky situation. The auditor's term is up, they're at the AGM, but the company plans to appoint someone else instead. Now, this isn't a removal before the end of the term, but the retiring auditor isn't left out in the cold. They still have rights under Section 140, subsection 4.
So, if the plan is to bring in a new auditor, a special notice is required. The company has to immediately forward a copy of that notice to the outgoing auditor. This is the trigger. It gives the auditor the right to write up their side of the story, a representation, and the company is then legally required to send that written statement to all the members before the meeting.
But what if the company plays dirty and claims a representation arrived too late to send out? Does the auditor lose their voice? Nope. They have a powerful backup plan. They can stand up at the AGM and demand that their entire written statement be read out loud to all the shareholders present.
Okay, folks, buckle up. We're now moving to the most serious provision of them all. This isn't just getting fired. This is the nuclear option. The ultimate red card for an auditor. Removal by the National Company Law Tribunal, or NCLT, for fraud under Section 140, subsection 5.
So who can press this big red button? Well, there are 3 ways this can get started. The NCLT can actually initiate it themselves, which is called acting suo motu, or the central government can file an application, and finally, any other concerned person can also bring the matter to the tribunal.
Once the ball is rolling, if the NCLT is convinced the auditor was involved in fraud, it can order the company to get a new auditor. And look how fast this can happen. If the central government made the application, the NCLT has just 15 days to pass an order telling the auditor to stop working immediately, and the government can then appoint a replacement. Just 15 days. That's incredibly fast.
And the consequence of a final order from the NCLT is devastating. It's this number, 5. The auditor, whether it's an individual or an entire firm, is banned from being an auditor for any company for a full 5 years. That is a massive career-altering penalty.
And just when you thought it couldn't get any worse, it does. On top of that 5-year ban, the auditor is also hit with liability for fraud under Section 447 of the Companies Act. We're talking about massive fines and even the possibility of jail time. The consequences are absolutely severe.
Phew! So we've covered the entire journey. How an auditor gets in, how they can be kicked out, and how they can leave. To wrap this all up, let's just quickly jump back to the very beginning, to the entry ticket itself. Who can even be an auditor in the first place? That's Section 141. The basic rule is simple. You know this. You have to be a chartered accountant with a valid certificate of practice. But this brings up a final, really interesting question to chew on. We just saw the insane liability for fraud, but what happens if the auditor is a partnership firm? The law is clear that the firm and any partner involved in the fraud are liable. So think about this as you revise. How does that shared liability actually work, and what can an innocent partner do to prove they weren't involved? It's a tricky one to consider.
Okay, you're on an audit, and boom, you find a fraud of exactly 1 crore rupees. What is your very first immediate action? Do you A, go straight to the central government, B, just resign and get out of there, C, report it to the board, or D, ask for a reply from the board or the audit committee? Now, I know what you're thinking. It's a huge fraud. Gotta report it to the top, right? The central government. But nope, that is the exact trap ICI wants you to fall into. The correct answer is D. Your first legal obligation is to report it to the board or audit committee and ask for their response. The process is king here, and we're going to break down that exact timeline later.
So, to get our heads around all this, let's put ourselves in the shoes of an auditor. Imagine we've just been appointed for XYZ Limited. What's our playbook? What are our powers? And what are our absolute must-do duties? From here on out, we're looking at everything from that practical point of view. This isn't just theory to memorize. This is your key to scoring real marks.
Okay, so before we get into all the things you have to do, let's talk about what you get to do, and of course, how you get paid. Section 143 doesn't just give you duties, it first gives you the authority and the tools you need to actually do the job.
So what counts as your remuneration? Well, obviously it's your fee, but it's also any expenses you rack up during the audit. Think travel, things like that. It also includes any facility the company gives you. Now, what's not included, this is important, it's any money you get for other services, like if you're also doing their tax consulting. That's a totally separate thing. And here's a neat little point from the study material. An engagement letter is still totally valid, even if you haven't decided on the exact fee yet. As long as you've agreed to figure it out later, the contract holds up.
Now, let's talk about your powers. This is your auditor's toolkit. Number 1, you have the right of access. And you see those key phrases, at all times and at any other place? ICAI absolutely loves testing these. It means nobody can tell you, oh, come back Monday, or sorry, the books are at the director's house. Nope, your access is non-negotiable. Second, you have the right to demand information and explanations from the company's officers. And third, if you're auditing a parent company, your right of access extends to the records of all its subsidiaries and associates. You need this to do your consolidation work properly.
All right, we know our rights. Now let's get to our responsibilities. Section 143.1 kicks off with a list of things you don't just check, but that you must inquire into. Think of this as your day 1 non-negotiable checklist. You have to ask these 6 questions.
So let's run through this checklist. First up, you got to look at loans and advances made by the company. Are they properly secured? And more importantly, are the terms of the loan actually harmful to the company's interests? Second, are there any transactions that are basically just paper entries with no real substance that are damaging the company? Third, if the company isn't in the business of investing, has it sold any investments for less than what it paid? Fourth, have any loans or advances been disguised as deposits? Classic window dressing check. Fifth, have any personal expenses been sneakily charged to the company's profit and loss account? And finally, number 6, if the company says it issued shares for cash, did it really get the money? These are your 6 mandatory starting points.
All right, after all that digging, all that inquiring, it is time for the main event. Delivering your final verdict in the audit report. This is the whole point of your audit, and trust me, every single word you write in here counts.
So what's actually in this report? Well, first off, it's addressed to the members, the shareholders. Your entire job boils down to expressing one opinion. Do the financial statements show a true and fair view? To get to that opinion, Section 143.3 says you must report on a few specific things. First, Clause A. Did you get all the info you needed? If they held anything back, you have to say so. Clause B, in your opinion, are the books of account being kept properly? Then you've got clauses C, D, and E, which cover things like, have you dealt with branch audit reports? Do the P&L and balance sheet actually match the books? And, super important, do they comply with the accounting standards?
And the list doesn't stop there. Under Clause F, you need to report any observations you have that might negatively affect how the company functions. Clause G is a big one. You have to check and report if any director is disqualified under Section 164, subsection 2.
Clause H is basically a catch-all for any other negative comments you have about the accounts. Then we have Clause I, which is all about internal financial controls over financial reporting, IFCFR. Are they adequate, and are they working? And you see that little note? We are definitely going to circle back to this one, because there's a huge exception you need to know for your exam. Finally, Clause J asks if there are any other matters to report. And the answer is a big yes, which takes us straight to Rule 11.
Okay, before we dive into Rule 11, let's just quickly decode some jargon that can be a bit confusing. An intermediary is basically a middleman. You give them money with the specific instruction to lend it to someone else. A funding party is the opposite. They give you money with the instruction to lend it to someone else. In both scenarios, the ultimate beneficiary is the person at the very end of the line who actually gets the funds. Got it? Cool. That's going to make this next part much easier.
Okay, so what other juicy details does Rule 11 make you report on? You have to report on the financial impact of any pending lawsuits. You need to check if they've made provisions for any expected losses on long-term contracts. You have to flag any delays in transferring money to the Investor Education and Protection Fund. Now, using our new vocabulary, you have to report on what management tells you about any funds that have been routed through intermediaries or receipt from funding parties. You also check if dividends were paid correctly according to Section 123. And this last one is a big deal, guys. It's a recent change, which means it's prime real estate for exam questions. For financial years starting April 1, 2022, you have to report whether their accounting software has an audit trail feature that can't be tampered with. Super important.
Now listen up, because this is a classic mistake that costs students easy marks in the exam. Section 143.4 is crystal clear on this. For any of those points we just covered, if you give a negative answer or qualify your opinion, you must, I repeat, must state the reason why. It is not enough to just say, the internal controls are not adequate. That's a 0 marks answer. You have to say why. For example, the internal controls over cash are not adequate because there is no segregation of duties. See the difference? Your reason is the proof behind your opinion. No reason, no marks. Simple as that.
Okay, let's shift gears. We're now moving into the red alert section of the audit. This is probably the most high-stakes duty you have as an auditor, reporting fraud. The moment you find a fraud, a very specific, very strict clock starts ticking. If you mess this up, the consequences are serious.
The law draws a very clear line in the sand, and that line is 1 crore rupees. It creates 2 completely different reporting paths. If the fraud is 1 crore or more, you have a 2-step process. You report to the board or audit committee, and you report to the central government. If the fraud is less than 1 crore, it's simpler. You only report to the board or audit committee. The responsibility then shifts to them to disclose it in their board's report.
Let's break down the timeline for those big frauds, 1 crore or more. Get your stopwatches out, because these timelines are non-negotiable and an absolute favorite of the ICAI. The second you have knowledge of the fraud, a 2-day clock starts. Within 2 days, you must inform the board or audit committee and ask them for a reply. Then you wait. You give them up to 45 days to get back to you. As soon as you get their reply, a new 15-day clock starts. Within those 15 days, you have to forward 3 things to the central government in Form ADT-4, your original report, their reply, and your own comments on their reply. Now, what if they just ignore you and the 45 days pass? You don't just wait around. The clock expires, and you immediately forward your original report to the central government and let them know you never received a reply.
Now, for the smaller frauds, those under 1 crore, the process is way simpler. Your job as the auditor is to report it to the audit committee or the board, and you still have that tight 2-day deadline. Your report needs to be specific. What's the nature of the fraud? Roughly how much money is involved, and who are the parties involved? And once you've done that, your direct reporting duty is over. The ball's now in the board's court. It becomes their duty to disclose all those details in the board's report.
Now, this is a 5-star, must-know point for any case study question ICAI might throw at you. Your duty to report directly to the central government only kicks in if you, the auditor, are the one who uncovers the fraud during your audit work. Let's say the company's own management discovers a fraud, they report it to the police, and then they tell you about it. In that case, your duty to report to the central government is not triggered. You still have to consider it for your audit report, of course, but that direct line to the government is reserved for frauds that you are the first to find. That's a critical distinction.
And if you're thinking, so what's the big deal if I mess this up? Well, the big deal has a lot of zeros attached to it. If you fail to follow these fraud reporting rules, the penalty is a whopping 5 lakh rupees for an auditor of a listed company and 1 lakh rupees for any other company. The law is not messing around here.
Okay, we've covered the main highway of Section 143. Now let's explore the side roads and secret passages where the real expert-level marks are hiding. Knowing the exceptions is what separates a good answer from a great one.
Okay, remember we talked about reporting on internal financial controls? Well, here's the get-out-of-jail-free card. This requirement does not apply to a private company if it's a one-person company or a small company. For other private companies, they can also get this exemption, but they have to meet two conditions. Their turnover has to be less than 50 crores, and their total borrowings have to be less than 25 crores. This is a super common area for MCQs, so make a note of those numbers.
But, and this is a massive but that ICI just loves, there's a huge catch. This entire exemption is only available if the private company has a clean record with the Registrar of Companies. If they have defaulted on filing their financial statements or their annual return, the exemption is gone. Poof. So, ICII can create a scenario where a company meets the turnover and borrowing limits, but they file their annual return late. In that case, sorry, no exemption. You have to report on their internal controls. That is a perfect exam trap.
And just to wrap things up, let's quickly touch on 3 other important provisions. Subsection 9 just makes it official. Every auditor has to comply with the standards on auditing. Subsection 5 deals with government companies, saying their auditor is appointed by the CNG. And finally, subsection 11 is the legal basis for things like CARO, which allows the central government to require auditors to report on a whole other list of specific matters.
And there you have it. That's the entire universe of an auditor's powers, duties, and fraud reporting under Section 143. We've walked through the whole rulebook. But it leaves you with a bigger question to think about, doesn't it? The law is clear, an auditor is a watchdog, not a bloodhound. So where do you draw the line? Where does your duty to report end and a full-blown detective's investigation begin? Something to think about. Thanks so much for joining me, and all the very best for your exams.